Thank you everyone for joining us. We try to keep these at 30 minutes. There was a lot of information on this topic though, so we're going to go over for about 10 minutes. If you know anyone that can benefit from this information, we'd love for you to share that with them. The best way to access the video is to go on our website, and all of our webinars are going to be under Videos and Insights tab at the top. And then once you get there, you can actually dial down, look for the Resources and Educational tab, and it'll have all of our webinars there. I'm going to go ahead and turn it over to Cooper. Cooper, would you like to maybe go over the agenda for us for today?
Yeah, awesome. Thank you, Robin.
Sure.
And it may not be that we have a lot to cover, it more so might be that I'm just long-winded and I get excited about some of this stuff. So I apologize in advance. I want to make sure everyone can see my screen okay. Okay, sweet. Well, welcome everyone. Everyone except Uncle Sam, right? The goal today is to try to anger him as much as possible. And these strategies, hopefully you'll be able to learn a little bit more about, how you can keep that money in your pocket as opposed to Uncle Sam's. Right. So, just a quick little agenda. You may or may not have seen this in the email, but I want to start with just kind of some basics on the tax return because I find it's valuable just to go through some of these things that we're going to build upon them in some of the strategies that I talk about. And then I'm going to start it with, one of my favorite strategies, Roth conversions. I get really passionate about this. So you'll see that in a second. QCDs are qualified charitable distributions. If we're donating money to charities, how do we do it in the most efficient manner? So I'm going to talk about that. Tax loss and tax gain harvesting, which you may or may not be familiar with, but it's something that's important. Asset location and aggregation. That's something that I think a lot of people don't take advantage of when it's really easy to implement and it has a really big impact. So we want to make sure we cover that. Medicare Part B and D for a lot of folks on this call. That is something that's always on our minds, right? And it is something that we need to pay attention to when we're doing these strategies. So I want to go through that as well. And then if we have time at the end, we may or may not, I'm going to go through a couple bonus items just to look at to make sure you're doing before the year end. But I'll just kind of dive into it and get started with these basics. Okay. So this is a report that takes your tax return and using our software kind of simplifies it as much as possible. So many on this call probably have seen a report like this. And this is helpful because your tax return is dozens of pages and it's hard to digest and hard to read. And so this does a good job of just kind of pointing out some of the main topics, right? And so I'm going to point out a couple things in here that is going to help in our conversation today. And so this is a couple that we work with. I'm going to go through a few different examples of different couples that we work with. And for them, they're retired, they have pensions, Social Security, some investment income. All of that adds up to about $192,000 a year. Okay. So that's what they're living off of. And what has happened to most folks since 2018 when Trump made the tax changes, right, is they are itemizing their deductions, right, at $30,700. And what happens is you can either take, the higher of itemized deductions or the standard deductions. So you can see over here that their total itemized deductions only amounted to $10,000 in comparison to that $30,000 standard deduction. So you can either take one or the other. And for this couple, it made more sense to take the standard, right? This is what I find, 90+% of clients are doing nowadays because they've increased that standard deduction and limited the itemized deductions since 2018. So that's going to come important when I talk about QCDs here in a second. But what they do, again, is they take that 192, they subtract the 30,000, and then you're left with this 161. And that's what you're actually taxed on, right? That's your taxable income. And if you remember, we have a marginal tax system in the US, right? So you see over here, they fell in the 22% marginal tax bracket, but their average rate of tax was only 11.7%. And the reason behind that is because, again, we have a marginal system. So the first 22,000 is taxed at 10, and then the next 67,000 taxed at 12, and then the next little bit was taxed at 24. So it's a blended rate, right? And again, this is going to become important when we start talking about these different strategies, is understanding the mechanics behind that. And then in addition, they did have investment income. So they had dividends and capital gains, right? And investment income is taxed differently than your ordinary income through wages, pension, or rental properties or anything like that. Okay. And so in the investments, you can see there's a separate tax bracket where you'll notice that there's a 0% bracket, a 15% bracket, and a 20% bracket. Okay. And again, this is going to become important as we start to talk about like the tax loss harvesting, tax gain harvesting, because when anytime there's a 0% bracket available to us, we want to make sure we're taking advantage of that. Okay. So again, that's just kind of fundamentals, but let's build upon that and kind of expand upon it, and talk about some of these strategies that I mentioned earlier. And first and foremost, I had to cover Roth conversions first because, again, this is my favorite topic to kind of coach folks through. And the best way for me to explain this is most Americans in the US build their wealth primarily through two different vehicles. One being their home, their primary residence, right? And then the other one is traditionally their 401k plan at work. Right, 401k, 403b, whatever the workplace plan is. And how those 401k plans work in the traditional sense is you put money in, right? You get a tax deduction in that year. Then it grows tax deferred. And when you go and you pull it out down the road, you have to pay taxes on the original investment plus any growth that has experienced over that course of time. And so what this actually kind of means is you kind of have a liability to the IRS for any money that you put in that's growing over the years, right? So you put in $100, you get that tax deduction in the year, so you save some money there, but then that money will sit there and grow, and you're going to have to pay taxes at one point in time, right? They say, nothing's certain except death and taxes. At some point in time, Uncle Sam's going to get his hands on that money, right? So we want to be conscientious of this and make sure we're doing it with the right intentions behind it. So that deduction is great, especially when we're in our higher income years, and makes a lot of sense for that when we are projecting our future tax bracket to maybe be lower. Okay. And so you got to be aware that you do kind of have this hanging over your head in a sense where if you have $100,000 in your 401k, it's really like you only have maybe 80 or so thousand because the IRS owns 20 of that. Right? And then as you get older, there's something called required minimum distributions or RMDs, and many on this call have probably heard of this. For those that you for those of you that haven't, these are required distributions from any tax deferred vehicle. So most likely those old 401ks, traditional IRAs, they say that once you reach a certain age, 70 and a half, 72, 73, 75, depending on when you were born, you are now required to pull out a certain percentage each year and pay the taxes on it, right? So even if you didn't need the money at a certain point in time, again, Uncle Sam's going to get his hands on it, whether you like it or not. Okay. So where can the Roth conversion come into play to help kind of relieve some of these issues? And the key here is knowing your current tax bracket and your projected future tax bracket. And so the idea is you take your pre-tax money that's in your traditional IRA or 401k, and you convert it to a Roth IRA. And there's no limits on this, right? You can do as much or as little as you'd like. There's no income restrictions, nothing like that. Anyone can do it. There's no age requirements. And so you take that money from your traditional, you convert it to your Roth, you pay taxes now, and then you never have to pay taxes on it again, right? You kind of get rid of that liability for any money that's in the Roth. and Roth IRAs are not subject to RMDs in the future. Okay. So that's kind of the mechanics behind it and why we might want to look at Roth conversions. But again, the key is knowing our tax bracket, right? So if we're in the 32% marginal tax bracket right now, it might not make a lot of sense to do a Roth conversion versus if we're in the 12 or 22. Okay. And so what we typically find is when we're working, in our 40s, 50s, 60s, our income is at its highest point, right? We're kind of at the peak of our career and our earnings potential. But once we retire, that income goes away. And that presents kind of the golden tax planning years when it comes to like Roth conversions and other strategies. And so I want to give you an example here because I think all of us can be visual in nature and giving examples just helps, right? So this is a couple that we've worked with and they're not on the call today, but they just retired this year. And so congratulations to them. It's always fun seeing, all the hard work pay off and then get to that point. But now that they are retired and that income has gone away, there is some opportunity here where we can look at the Roth conversion and see if it makes sense. Okay. So this chart shows the different tax brackets, right? And then their income and what is projected to be over their lifetime. So this one is the 10%, and then the 12, and then 22, and then 24. Okay. And you can see in their first year of retirement right here, they're really only projected to stay within that 12% bracket. Right? So if we compare that, without this yellow, this is the Roth conversion. So pretend like that's not there. And then let's compare that to these years over here. And you can see that they are pretty firmly projected to be past that 12% into the 22. And so this is a good indicator for us to say, okay, maybe it makes sense to convert now, get it in the Roth bucket where it's tax-free, and then any future growth is tax-free. It's in their pocket, not Uncle Sam's, right? So it looks like for us, if we want to stay in this 22% bracket, we have about $100,000 or so in wiggle room that we can play around with. All right. And we'll take it year by year, right? It's not going to be the exact number every year. And we got to be conscientious of other things, which I'll talk about in a second. But you'll notice that, we have 10 or 15 years here where we can complete these Roth conversions, get it into the Roth. And by doing so, this is what's so powerful about it. The program actually can calculate what the tax savings would be. And you can see it saves them nearly $400,000 over their lifetime. So not everyone is going to be able to save $400,000, and it's unique to everyone's situation. But if it can save you $5,000 or $20,000 or $100,000, why wouldn't you at least look at it and uncover that stuff? And what's even more incredible about the Roth conversions is not only do they save $400,000, but their heirs will also save a ton of money in taxes. And the reason behind that is because there is a rule with IRAs, and this happened in the Secure Act of 2019, and they changed it. And they said any inherited IRA that is not from a spouse, so let's say your kids inherit your IRA, all that money has to be dispersed within 10 years. They call it the 10-year rule. Okay. So let's say you have, $1 million in your 401k, your traditional IRA, and your kids inherit that. Well, that means that they have to pull it all out plus any growth within the 10-year period and pay the taxes on it. And most of the time, right, kids who do inherit these assets are still working and still earning a good income and could be in a higher tax bracket already. Then you throw on top all these distributions that have to happen, and it kicks them into an even higher tax bracket, and they're losing 30, 40, even sometimes 50 cents on the dollar. So instead of inheriting $1 million, they're inheriting $500,000. Right? So the Roth works differently because it's not taxable. So the 10-year rule still applies. However, all they have to do is keep it invested for those 10 years, let it grow, and then at year 10, they can just pull it all out completely tax-free. right? So think about $1 million, then over 10 years, let's say it grows to 1.3 million. Well, now they inherit 1.3 million as opposed to the 500,000 in the other strategy. So this is that same client, right? And again, they've positioned themselves really well. They are on a trajectory where there's going to be a lot of money left over for their kids, their grandkids, and their legacy, right? And so what does that legacy look like with the strategies and without the strategies? You can say by doing these Roth conversions, they have way, way more in that Roth bucket, right? And their heirs are going to be able to inherit that completely tax-free. In the other strategy, there's more in this qualified and taxable bucket, which aren't as great to inherit as the Roth. Okay. So not only does the Roth conversion save them in money, but it's also going to save their heirs hundreds of thousands of dollars as well in taxes. And you can probably see that's why I get so excited about this. And again, it's not going to work perfectly for everyone, and everyone's situation is going to be different. You do have to prepare yourself for the tax bill now, and you have to have the appetite to do it, right? Because if you're in a situation where you just want to pay as little taxes as possible, it's going to be a very hard pill to swallow for you to have to pay taxes on a $100,000 distribution right now. Okay. Now, there's some ways that we can go about it in terms of funding the bill. We can withhold it automatically from the IRA in the conversion, so you don't have to come out of pocket, or we can make payments out of pocket or from another investment. But again, this is something that everyone should look at, and we help clients with all the time. Okay. So shifting gears just a little bit, the Roth conversion will save you in taxes over your lifetime if it implemented correctly, but it will increase your tax bill in your current year. So is there a strategy that you can actually do both, where you decrease your income and your taxes in this year, and then over your lifetime, you still pay less in taxes? And the answer is yes. And that is a QCD, qualified charitable distribution. Now, I am going to say this first and foremost. You're never going to make money by giving money away, right? But there is strategies out there where you can save money if you do it more efficiently. And this one is really the biggest one, qualified charitable distributions. I know I'm throwing a bunch of abbreviations at you, RMD, QCD. Our industry loves to do that. I don't know why. It makes things confusing, but this is the last one I'll make you learn. But it's important. And what it says is that after you reach 70 and a half, you are now able to take money out of your IRA directly and move that to a charity, donate to a charity, and you don't have to pay any taxes on that distribution. And because the charity is a 501c3, so it's got to be a 501c3, they don't pay any taxes on that as well. So Uncle Sam misses out on any money that's donated to that charity. And this can be really powerful, especially because a lot of folks are no longer able to itemize, right? Because if you're not able to itemize, your charitable deductions are itemized deductions. So back in this, example that I gave you, right? They had charitable donations of $3,000 and they didn't get any deduction for that. Okay. So the QCD allows us to bypass that, where you still get the standard deduction and you get to have deductions for these qualified charitable distributions. All right. So just to kind of further illustrate this is again a client that we've worked with on this case, and they're in a position where they don't need their RMDs, required minimum distribution. And based off of projections, these RMDs of 50, 60,000 a year, they were going to kick them in a higher tax bracket and increase their Medicare premiums, which I'm going to talk about in a second. And so we strategized and said, okay, well, is there something we can do to reduce the income? And previously, they had in their estate plan that they wanted to gift their house to their alma mater, right? And so we looked at it and we're like, well, there's a much more efficient way to do this, because you don't want to gift the house because that's going to get a step up in basis for your heirs, right? Instead, the money that we want to donate to charities is the IRA money that's never been taxed before, right? And so we looked at it and we engaged with the university, and they made a commitment to donate their RMDs each year until they reached like what the home value was at, right? And in exchange for that, the university created scholarship funds for them, and they were able to see, each year the difference that they make, the kids that they're helping. So it was a lot more of a positive experience in seeing that. And they're also saving in taxes as a result of it, right? So if they were just to donate that money, right, they would be able to itemize them because it would increase their itemized deductions to 56,000, but then they wouldn't get the standard deduction. So by doing it via QCD and still taking that standard deduction each year, it's saving them about $7,000 in federal taxes, plus state taxes, plus the savings in Medicare, which I'll talk about here in a second. So this can be, again, really powerful, especially when we do have charitable intent. If you don't have charitable intent, it's not necessarily something that applies to you. But essentially how it works is we just work with the custodian and we have a check made payable directly to the charity. So that's important. It can't be made payable to you or it is taxable. So it's got to be made payable to the charity. Then we send it to the charity directly, or we send it to you. You hand deliver that check. Make sure you keep a receipt because just in case you ever were to get audited, you want to keep that paper trail. And then you want to also let your CPA know that, hey, I did a QCD, and to make sure that they code it correctly, because if not, they'll probably just code it as a distribution. So something to keep in mind there. But that's QCDs, right? And again, we'll open it up for questions after, but I'm going to keep moving and grooving because we don't have a ton of time. Next is tax loss harvesting. Okay. So the first two strategies primarily were focused on folks who are in that kind of de-accumulation phase, right? Where they're living off the assets and distributing the assets. But are there also strategies out there that can help our accumulators of wealth as well as our decumulators of wealth? And there are a couple. The first one being this tax loss, tax gain harvesting. So again, building off that principle of the capital gains bracket, there's another kind of feature with investment income where you can offset any gains with losses, right? So, look at this balance right here. Any gains right here, they can be offset with any losses that you experience. So that gives us the opportunity to potentially create paper losses and bank them for future gains in the future, right? So you can hold on to these losses into perpetuity, and each year, as you have any gains in your portfolio, you can offset them with those losses that we bank. Tax loss harvesting, again, the valuable thing is you can bank these paper losses and use them in future years, right? And so I want to give you an example here. I worked on very closely with a client, and this was a little bit of a unique situation that worked out, very well in his favor. But we see opportunities like this all the time, right? So what had happened is in 2021, they inherited a pretty sizable amount. It was about $1 million, okay? And this was in the end of 2021. And if you remember, 2022 is not the best year for the stock market. On average, market went down about 20% that year. And so what had happened is they inherited this $1 million at the end of the year, and then their basis was $1 million, and the accounts pretty quickly went down, right? And so what we were able to do is sell those securities, right? Not actually, we don't have to make any distributions. We just have to sell the securities, buy back substitutes for a 30-day period, and then we can go back into those original securities, whether it's ETFs, mutual funds, individual stocks, whatever the case might be, right? Because there's a 30-year wash sale that the IRS outlines that you have to wait at least 30 days before buying back that original security, or the loss isn't valid. And so we were able to do this with them, right? And through that, we were able to bank over $200,000 in losses that now this client can use for the rest of their life as long as they have gains, right? And even if they don't have any gains, the IRS allows them to deduct up to $3,000 every year from their ordinary income into perpetuity. Okay. So again, this isn't a situation where it's available all the time. It's really when the opportunity presents itself, and we got to stay on top of it, right? So the market has a downturn. Those are opportunities for us to look at tax loss harvesting and see if there's anything we can do to, again, create those paper losses. Because again, since 2022, the portfolio has recovered and grown and is now well worth over $1 million, right? But we still have these losses that we can use. Okay. So that's tax loss harvesting. Tax gain harvesting works a little bit differently. And again, it goes back to that capital gains bracket. So this is another example where I worked with clients pretty closely on this. And their history, they were both executives at bigger firms, had been very successful, had been at a high tax bracket most of their life. Okay. And so they were very, very ready to not pay as much in taxes. And so we had, multiple different strategies and possible solutions, but the most appealing to them was to limit their tax bill as much as possible for these first couple years, just to, again, because they had been paying so much, they wanted to have a couple years of relief. Okay. So what we did is we generated income to them through their brokerage account or their wealth accumulation account. That's what we call them. And we generated about $15,000 a month to them in income. And because that was capital gains assets, you can see that we were able to stay within this 0% capital gains bracket and realize about $55,000 in capital gains. Okay. And on that $55,000 in capital gains, and again, they generated more money because some of it was returned principal. They paid $0 in federal taxes. And then on top of that, we also did some Roth conversions of about $50,000 where they were able to deduct that standard deduction. And then the other 30 plus thousand was taxed at 10 and 12%, right? So we provided them the income stream that they needed to live off of. They didn't pay any federal taxes for their capital gains assets. And we were able to convert money from a traditional to a Roth for that tax-free growth. Right? So that's an example of tax gain harvesting. And when we have lower income years and there's potential for being in the 0% bracket, we want to make sure we're looking at it and measuring the impact there. Okay. So again, these things are valuable, and it happens all the time, right? You could take a hiatus for work. You could be in between jobs. You can have a lower income year from a business perspective. All of these things can create opportunities where we can look at this. Okay. So that's tax gain harvesting. A couple other things in here. Again, this is inclusive of accumulation folks and decumulation folks, and that's asset location and aggregation. So traditionally, and this is how most people do it, is they will create an investment plan and then they will duplicate that in all of their accounts, right? So you can see these accounts. You got an IRA, you got a Roth IRA, you got a taxable account. Okay. And you'll notice that this pizza is the same between this account, and this account. Okay. That is the most common way that people do it because that just makes sense intuitively. Your accounts are going to grow the same. But what the science has shown and the research has shown is that if you can strategically place those different slices of the pizza in the different account types based off the tax consequences, you're going to do a lot better over the long run, right? So let's say your Roth IRA, we want to own the most aggressive assets or the most aggressive slices of that pie to get the most tax-free growth. Like your smaller companies that grow more, right, and have more upside, we want to own them in the Roth. So any growth that's there is tax-free versus your IRA. Hey, maybe we want to own the more conservative investments like your bonds, because one, that decreases that liability to the IRS, right? Two, it decreases your future RMDs. And then three, any coupon payments that you get from those bonds, the interest payments that come in, you don't have to pay taxes on them because it's in a tax deferred account. Versus if you had those bonds in here, you'd have to pay taxes on them at ordinary income rates, right? So this is valuable. And this chart kind of shows and measures a little bit of the difference where over a 10-year period, by just duplicating it, that money grows to 1.29 million versus by using asset location and aggregation, there's an extra $40,000, $50,000 in your pocket. And it's easy, right? There's no cost to doing so. It's something we can implement immediately, and something that we work with clients all the time. And Vanguard actually did this study right here, where they kind of tried to quantify the difference that it can make, and they showed that it can add up to 0.6% per year in after-tax returns just by strategically placing those assets. So something that's valuable, and something that we talk with clients about all the time. Just a couple last things in here to cover. Medicare Part B and D. This is a big one because every time we're doing these strategies, it's going to impact our Medicare premiums. And the reason behind that is because Medicare premiums are means tested, right? So many who are on Medicare probably know this. Some who are not quite there, this might be new information. But essentially speaking, the more money you make, the more money you have to pay for Medicare. And it doesn't matter, you're not getting better service, you're not getting a better plan. It's the exact same plan. You're just paying more because you earn more, right? So how it is calculated is, and this is for a married couple, right? If you're single, the number is cut in half. So, 103,000 for single. And as long as you stay under these thresholds right here, you will have no increase in your Medicare Part B, which is just your traditional Medicare plan, or Part D, which is your prescription drug, right? So Medicare premiums start at 165, right about per month. And what you'll see is if you go $1 above, even $1, so it's a cliff, right? Your Medicare premiums will go up by $70 a month. And if it's a couple, that's times two. So $140 a month plus $26 a month for Part D, right? So that's another $166 a month that you're paying for Medicare just because you earn $1 over 206. Right? And you can see again how much of a difference it can make as your income goes up. And so if we're looking at, this year and you're on Medicare and you're within one of these ranges, right? Well, what are some things that we can do to maybe get you just below a threshold, right? So if you're projected to be at 207,000, could we do a QCD of $1,000 and then get you under that Medicare premium and save you the $166 a month, right? Or could there be some tax loss harvesting or whatever the case might be? And conversely, right, if we're doing these Roth conversions, that's actually going to increase your income and could potentially increase your Medicare premium, right? So we have to measure that. We have to know that doing the Roth conversion is going to save you more in taxes than it's going to cost you in increased premiums, okay? And this is recalculated every year. So it's not like if you go over 1 year, you're stuck there for the rest of your life, right? So every year it resets. And it's based off of the tax return from 2 years ago. So these premiums for 2025 were based off of the tax return in 2023. So this year is going to impact your premiums in 2026. And if you are of Medicare age, right, when you reach 65, that means they're going to be looking at your tax year at 63 to determine what your Medicare premiums are going to be. Okay. So again, something that we need to keep in mind, and what I've found with folks is people hate paying more for their Medicare premiums. Even like I've done Roth conversions where we've saved $100,000 in taxes, and then for 1 year they had to pay additional amount in premiums, and they said I'm never doing that Roth conversion thing again because it just the emotional piece to having to pay these premiums, it angers folks. But at the end of the day, our job is just to educate you on this, measure it, and then you can make the decision in an informed manner. So that's Medicare premiums. I do think we're kind of out of time because of the loss of power. So there's some bonus items. I'll save this for the end if people have time, and come back to it. Just quickly in kind of summary, what we covered: tax return fundamentals, just basic 101, how tax brackets work, the different thresholds, all the mechanics behind it, right? And then we covered the Roth conversion, and I'll draw a little heart because that's my favorite piece. We talked about QCDs and how if you're charitably inclined, we should definitely look at this and make sure that we're saving you as much as possible in taxes through that. Tax loss and tax gain harvesting, right? If there is a window where the market goes down and there's an opportunity, then Ray or I are going to be looking at that and calling you, right? And saying, hey, we do have an opportunity, let's move forward, and so on and so forth. Asset location, aggregation. We try to do this with pretty much every client where it makes a tangible difference. If you have any questions on it, please let us know. Medicare premiums, that's a bad one. Thumbs down on that. And then I'll come back to bonus items in a second. But just in conclusion, really quickly our job, in addition to helping you with these strategies, is also helping coordinate with your other professionals, CPAs, tax planning professionals, right? So, this chart right here is key partnerships. If you have not introduced us yet to your CPA, or if we haven't worked, together, please do so. We'd be happy to have a conversation, include the CPA on it, and see, if there's anything that he's missing or that we're missing, or anything that we can do to help you on the tax front. So I'll leave it there. I'm going to pull back up that slide that I had before. And I want to talk about a couple of those bonus items because these could be somewhat valuable for some folks on the call here. The first thing I'll just quickly mention, right, is every year you are eligible to contribute to your 401ks, your HSAs, your Roth IRAs. Those are all tax favored accounts. And if you have the cash flow that permits it and you are eligible for it, you always want to make sure you're trying to maximize that, right? So for clients who are looking to reduce their income, making that traditional IRA contribution is important. For the Roth IRA, that's more of like a long-term tax-free growth. But a lot of times people will think that they're contributing the max on the 401k and not realize that they're just under, right? Because every year it goes up. So it's a good exercise every year just to look and say, hey, inflation went up, they adjusted the 401k contribution limit. Let me make sure I adjust my contributions and my payroll to ensure that I'm maximizing that. Okay. And then kind of on that front, it's always a good exercise each year to look at your withholdings, because so often I see folks who under withhold, and then every year you'd think that they would get a grasp on it a little bit, but every year they're hit with this massive surprise come tax time where they under withheld, they owe a lot in taxes in April, and they get hit with the safe harbor penalty for underpayment, right? So again, good exercise just to look each year and say, okay, am I withholding enough? And the best indicator that you're not withholding enough is if you are owing a lot of money when you go and file your taxes. Ideally, what you would do is you would have withholding set to about where in April you don't get a refund and you don't really owe much money, right? Because most people, they really like getting that refund, but essentially that's just a tax or an interest-free loan to the government, right? So you'd rather have that money in your pocket working for you. And so if you're under withholding, just reach out to HR and adjust your withholding accordingly for 2025. Okay. Tax credits are super valuable. This one, honestly, there's not a ton of tax credits out there. They've just recently enhanced the child tax credit, so that's helped a lot of folks. There's a lot of energy related credits right now that could be expiring depending on how this election goes, right? So solar credits, electric vehicle credits, things like that. There's also a lot of education credits out there for folks who have kids in school that we want to make sure we're taking advantage of. So just look for those or ask your CPA, hey, just want to make sure we're taking advantage of all credits possible. The RMD one is a big one. And because the penalty is so severe. So each year, your RMD is calculated, and you have to pull out that amount within that year. Right? And if you don't, let's say your RMD is $10,000 and you miss it, you just aren't thinking about it, you miss it. Well, they're going to hit you with a 50% penalty on any money that didn't come out that was supposed to. So if you miss that $10,000 RMD, you're going to owe them $5,000 in penalties. So that's something that's really important for folks who are of RMD age. And, for us and with our office and working with you, this is one of our jobs and responsibilities. Catherine has this wicked spreadsheet that she's always looking at, making sure that everyone's satisfying their RMDs. So something we do for you, but not a client, or if you want to just confirm, it's not a bad exercise. This 2026 sunset, this is an interesting one because obviously the election is at the forefront of all of our minds here coming up next month. Once the election concludes, you're going to start hearing a lot of talk about tax code changes. And the reason behind that is because when Trump passed his tax cut in 2018, the code outlined that if it doesn't pay for itself, which it hasn't even come close, it will sunset in 2026 and revert back to what it was before 2018. So what that means for everyone on this call, if it reverts back, everyone's tax bracket is going to go up, right? So there's most likely going to be some changes that happens with the presidential election, right? Where they're going to make, certain policies and plans of, oh, I want to do this or I want to do that. But if nothing happens, which could easily happen with Congress, I mean, they're not very fast to move. In 2026, it's going to sunset. So if we're doing Roth conversions now, tax brackets are lower than what they're going to be in 2026. So we want to keep that in mind. This is just a really quick hitter. A lot of people don't realize that any money in their FSA, flexible spending account, this is for health expenses, they have a use it or lose it rule. So a lot of times people will have money in their FSA, they won't use it, and then because they don't use it, they only can roll over a few $100s into next year, and they miss out on all that money that they contributed. So that's an easy one. Just check, hey, if I have an FSA, how much money is in it. The HSA works differently. If you have money in your HSA, that can, you can roll that from year to year, no problem. So something to keep in mind there. And then this last one, this is a big one that's new this year. And Mike and Annabelle on the call, I know we've talked about this this year. Previously, they hadn't really solidified a lot of the mechanics behind doing so. They have just all the custodians and institutions have all recently kind of finalized their paperwork process. So now it's something that we can begin to do. And essentially what happens is they passed this last year and they said, any money that's in a 529 plan that is not used can be rolled over to a Roth IRA for that beneficiary or the kid, right? So this is important because folks who previously had unused 529 money, there was really nothing you could do unless you were willing to accept the penalty, right? There's a 10% penalty, plus you have to pay taxes on the gain. Now this allows us to roll those funds from the 529 directly into the Roth IRA up to the annual limit of $7,000 if you're under 50, $8,000 if you're over 50, right? So you can only do about 7,000 a year, and this is the first year that we can do it. So we want to make sure we're getting that in this year so it doesn't delay the process by a whole nother year. But I'll open it up for questions now. Is anyone head spinning after that, or did we feel like it was fairly, Annabelle's being honest, church is spinning just a little bit?
Hey, Brian, I'm glad you brought up the CPA though. Sometimes when you come into the office for your meetings, we'll ask for that information. And one of the reasons is so we can get them any information that is helpful for your tax situation. So there's letters that we can produce and get them rather than having to get you. So it's one less step. So if you happen to change CPAs or if you're looking for CPAs, we can help in that area. But yeah, making that introduction is really an important piece to all of this.
Again, appreciate everyone listening and joining.
If you have to take an RMD and you take the RMD, can you roll it into your Roth?
You can't, technically you can't, unfortunately, because there's a rule that outlines that RMDs have to be satisfied before the Roth conversion takes place. And if you were to complete a RMD, you have to pay the taxes on it, has to settle, and then you're eligible for a Roth conversion. And at that point in time, you've already done the RMD, you've already distributed the money, you've already taken control of it. And unless you have earned income in that year, you can't contribute to a Roth, right? So the only account that we can roll an RMD in is a brokerage account or a wealth accumulation account. You can absolutely invest that money, but you don't get the tax-free growth that the Roth would provide.
So I heard if you have earned income. So if I have a part-time job, then am I eligible to put into the Roth?
Yes, up to the $8,000 a year limit. So as long as you've earned at least $8,000, you can put that $8,000 into a Roth, but you can't put any more than that because that's the annual limit that the IRS outlines. That was a great question.
Cooper, I've got a question for you on the Medicare Part B and D. The income that they're measuring against, is that regular income, or does that regular income and capital gains?
Yeah, good question. It's your MAGI, Modified Adjusted Gross Income. And there's actually a few different versions of MAGI, but for Medicare, what you'll see is it is your AGI plus any tax exempt interest. So like, let's say you own muni bonds that are tax free, they'll even go back and count that as income. And your AGI is inclusive of pretty much everything. So, you know, the only things that like get deducted before AGI are like 401k contributions, or like self-employment insurance deductions or self-employment health insurance deductions, things like that. But for you, Mike, it's going to be pretty much the whole nine. All right. Well, I appreciate everyone again for the time. Thanks for joining.
Thanks, everyone.